cetera, the overhead, the employees, what's free cash flow? And then what are they doing with that free cash flow? Are they paying it back to you as a dividend? And that might be a good thing. Or are they investing it in acquisitions or creating new products through research and development to give the hyper growth that maybe someone in a growth investor is looking for? So that's fundamental analysis. When we come back from the break, we're going to talk about technical analysis and how that works. And then we'll put it all together on why you would want someone to know how to do both. You are listening to Retire for Real Radio. I'm your host, David Brooks. If you have information or questions for the show, just give us a call at 772-237-3440. We'll be right back after these short messages.
Today's broadcast is sponsored in part by Eastside Urgent Care. It's a positive alternative to the emergency room. Courteous, effective care from one doctor, Dr. Christopher Olek. It's across the street from the Indian River Medical Center behind Perkins. Eastside Urgent Care. Your very favorite restaurant food delivered directly to your door. That's right. Log on to chowcap.com. Chowcap.com. Now they have arrived at Vero Beach, delivered direct to your door from your favorite restaurant. Chowcab.com. Good morning, listeners. I have really good news for you. If you have a problem with varicose or spider veins, we have an experienced vascular surgeon right here in Vero Beach that specializes in this rewarding procedure. Veins disappeared, never to be seen again. The doctor is Renee Remdev. Dr. Remdev is a board-certified vascular surgeon with a Harvard medical degree. Dr. Remdev is an experienced medical doctor qualified to do carotid artery procedures. They black the nasty plaque. Best of all, his primary office is in Vero, with additional offices in Sebastian and Fort Pierce as well. Dr. Remdev is affiliated with 3 hospitals. When you need the very best, call Dr. Remdev at Vascular International Vein and Associates. They call it VIVA. The Vero office is 936 37th Place. Dr. Remdev is as pleased to get rid of those unsightly veins as you are. Call 772-567-8482. That's 567-8482. Watch them disappear. Hi, this is Mark from Coastal Connections. We're conveniently located on 12th Street and US 1 in the Public Shopping Center, 1275 Suite 2. And we'd love to help you with your shipping needs as you get ready to head back north. Help you with golf clubs, clothing. We're going to make it easy for you. So come and see us at 12th Street, US 1, the Public Shopping Center. Mark with Postal Connections. You can reach us at 772-778-4241. Thank you. Say that number again. 772-778-4241. Postal Connections is good enough for the mayor. He'll do a great job for you, I promise you.
As the body's largest organ, skin is the great protector. Skin cancer is the most common of all cancers. Protect the health of your skin with regular exams by a board-certified dermatologist. Specializing in the treatment of skin cancer, Treasure Coast Dermatology has offices in St. Louis.
I just want to be on camera.
Do it.
I just want to be on camera. Isn't it so boring when we do this thing live?
I know.
Breaks feel so long.
I know. I'm like, is the break really this long? What do I do?
That'll teach you, man. Don't you want to pre-record?
If you want to look like you haven't touched a class,
Yeah, we
go
have
to
another
Touch
minute.
It
I was
Class
like,
Dry Cleaning. They have free pickup.
I'm not used to this.
Huh?
I'm not used to this long time. Like normally I pull up the rejoiner, we start the next second, we
I
go.
know. I'm like fired out. Last time we usually are able to do a show in about 48, 50 minutes.
Yeah.
Be done.
Oh, I think Surfer's my last spot.
Fire, water, or mold damage strikes your home or business. Call Surf Pro of Vero Beach at 772-770-0501. That's where you'll find a team of specialists that's faster to any size disaster. So when the things that matter most are on the line, make sure Surf Pro of Vero Beach is too by calling 772-770-0501. Helping make fire, water, and mold damage like it never ever happened. Franchise agreement and owned and operated.
All right, we are back. This is David Brooks. I am your host, and you are listening to Retire for Real Radio. Thanks for spending the time with us. Before we went to break today, we were answering a listener's question on what is the difference between fundamental and technical analysis. So if you're working with an advisor or you're trying to do it yourself and pick an investment, what are the things you need to look at? What kind of due diligence do you need to do? And so we spent the last few minutes talking about fundamental analysis and how that is just that. It's what's fundamental about the company: earnings growth, revenue, how many shares are there, what kind of leadership does the company have, do they have new products or services coming to market, are they acquiring any companies? This is all fundamental analysis. You're digging deep into the numbers, you're reading the quarterly reports, or you're having somebody do this for you, and you're making a decision based on the fundamental analysis. Hey, this looks like a great investment. And sometimes this will happen. Someone will make a thesis and come up with a great idea. Hey, I believe fundamentally this is a sound company and I think we should invest in this company. And then sometimes what happens is the stock drops 20 or 30% in the next year. So fundamentally you're frustrated. You've lost money in this investment. Why is that? Well, because the timing of the purchase, even though the fundamental analysis was sound, may not have led to a great decision as to when to buy it. So that leads us to technical analysis. And what technical analysis can do is help people make decisions as to when to buy and when to sell, which is a huge problem with do-it-yourself investors. They very often don't know when to cut loose or to sell a loser investment, or even a winner for that matter, right? So how do you know when to buy and when to sell? Well, this is where technical analysis will come into play. And so this is done on a couple of different metrics. So there's a lot of different technical analysis metrics you can use as well. So some of the most basic are, if you pulled up a chart on any financial website, Google Finance, Yahoo Finance, and typed in the ticker of a stock that you like, they'll typically put up a picture of a chart. And this chart can be manipulated in a myriad of ways on the timelines. Most typically, you're going to see what's called a daily chart, and it's going to have how the stock has performed every day. And then you can change it, whether it's a linear graph, candlesticks, dots, plotted graph. There's a myriad of ways you can adjust that. We're not going to go into that today. But that will give you an idea of to show you how the stock is done. And of course, when we buy investments, we want low left, high right. In other words, we're looking for something that on a graph starts in the lower left corner and works its way to the upper right corner, because that means it's steadily growing in value over time, right? And that's why we would invest, right? So technical analysis can tell you, the charts can sometimes tell you when there's a problem. And as big Wall Street technicians used to always say, the stock, where the money flows, the stock goes. And so if big institutional money is purchasing a stock, it's typically going to support that. And you can see that in volume. So in other words, if you look up an individual stock on one of these financial websites, usually they'll show you somewhere what the average daily volume is in a stock. So if the average daily volume in a stock was 2 million shares traded every day, and let's say that the company comes out with favorable earnings and the stock jumps up about 3 or 4% that day, right? And it does it on 300% the normal volume. It trades over 6 million shares that day when its average daily volume is only 2 million. That's a bullish technical indicator. Volume, strong volume, it reacted positively to some sort of news, and now technically it's showing that it could be breaking out. Now, there's all kinds of charting patterns, and we won't have time to get into that today. And of course, we're on radio, so I can't show you what these charting patterns look like. But if this is something that you think excites you or you would like to learn more about, and this is more so for do-it-yourselfers than anyone else, but if you're a DIY investor, you need to learn how to read charts. You need to learn technical analysis so that you don't make mistakes on the technical. And there's a lot of great resources out there. If you would like help with that, steer you in the right direction, maybe help you understand a book that you could read to figure this type of stuff out, you can send us an email at info@retireforreal.com, info@retire4real.com, or just call in 772-237-3440, and we'll get you started in the right direction. But technical analysis has a lot of different metrics that people use and market technicians will use. The most common are what we call moving averages. So if you have the 50-day moving average and the 200-day, and if you're at home and you're learning, you want to write those down, 50-day and 200-day. Those are the most commonly used moving averages for people that are charting a stock. And what it simply is it tells you what's the average price of the stock over the last 50 days and the last 200 days. And the last 200 trading days is almost a year, right? So you're going back a pretty good ways. So you can see if that 200-day moving average is steadily moving slightly up to the right, then that stock has been performing well. But if the 200-day moving average has taken a big turn down, then the stock obviously has had a little bit of hiccup here recently. And this is where you have to decide, is it a good time technically to buy the stock? And a lot of times people have a stock that they've done the fundamental analysis on, and then the market technically breaks down and the stock falls significantly in value. And they think, oh, I like this stock. It was $40 yesterday and today it's 32. I'm going to buy it. But the old adage, you never want to catch a falling knife, which technical analysis helps you avoid, because you don't want to buy something just because it's shot down necessarily on some violent downturn. There's usually a reason why the stock turned down. So technical analysis will help you understand, is it safe to come back in? So usually you'll see the stock have to create some form of base before it starts back up, or is it going to be a quick V-shaped recovery? Was it an anomaly? What made the stock drop? So this is why you have to do both fundamental analysis and technical analysis. So the 200-day is a nice, long, broad-based moving average that can help people understand where the stock has been basically over the last year, right? And if it's a quality dividend-paying value type stock that's Clorox or Procter & Gamble or something, typically these stocks don't move a whole lot because they're dividend. They're putting the cash back in the shareholder's pocket. So they should have somewhat of a steady chart pattern. But if it's a high growth stock, it may have looks like a mountain on the chart. And there's all kinds of patterns we can show you to look out for. And we're not going to be able to get into today, but like one of my favorite is called a cup and handle. This is where a stock goes down, bases for a little while, and then comes back up again. And that's called the cup. And then it'll typically trade sideways for a little while because there's what we call overhead resistance. People that already own the position that are just happy to get out even. People that own the stock and bought it at 40, if it dropped to 30 and traded between $30 and $32 for 6 or 8 weeks and then started to work its way back up to $40, those people are so excited they're going to get their money back. They sell when it gets back to even. So the stock has trouble breaking through to the upside. And this creates what we call the handle on a cup and handle formation, excuse me. When this stock finally breaks to the upside after that handle, that can be a very bullish and positive situation technically. So if the fundamental analysis is good and you see a technical breakout from one of these type of patterns, that's a great time possibly to buy that individual equity if that's what you're choosing to do. Now, got to stress this, we're not making any recommendations for anybody to buy any equities or anything on the show. However, for you do-it-yourselfers, this is a huge learning piece. We find a lot of people that choose their own investments have no idea about, and just a couple of simple metrics here can really improve their performance. Technical analysis can also be used, this is very important, on how to sell an investment. In other words, let's say you bought into an investment and you want to figure out, hey, it's not going so well. I'm down 6-7% already. Should I hold this investment, buy more, or should I sell it? Well, that's going to depend on you, what your outcome is, what your time frame is, and what your risk tolerance is. But if you're buying individual equities, if you learn how to put a bottom to how much you're willing to lose, so if you sold it, the investment after it went down 8% every time and let your winners run, you're going to come out in the end, even if you buy more losers than winners. You don't even have to have as many win. So this is very important. So technical analysis tells you when to buy and when to sell, and fundamental analysis tells you what to buy, right? So both of them are very important. So if you're working with an advisor, you want to have someone who explains this to you very well. We're coming up against the news break here. If you have questions on what we're talking about today, 772-237-3440. I'm your host, David Brooks. We'll be right back after these messages.
I'm glad you realized. I put that up there. I'm like, I did tell him that, he breaks somewhere in the 3 minutes. Break, whatever. I'm like,
mid break is a hard break.
I'm like, oh, hard break. Yeah, top of the hour is a hard break too. I was like,
how many minutes do we have?
News is 4 minutes. So you got 4 minutes.
small town, gave himself like a $60,000 raise, and so the local news reporter gave public record for the last four.
I think Bell, California, they all lose themselves like $100,000 salary cover for that. Yeah. You know, it's something ridiculous. All starting to find that money. It was like, but that's what we're doing.
Hey, while he's here, you got a camera? I need a good high-res picture of him. He's never gonna send it to me like he's supposed to. And he asked, seriously, right now, he's on break. You got 2 minutes to take a picture, and then wait till afternoon, right? Yeah, Bixby's our official photographer, takes exceptional shots. He really is, just the right, you want to go in the studio? Okay. Because we're gonna put pictures of all our on-air personalities on this wall right here, really want them, right?
Huh? We're doing it actually at Alvin Terry. It's a little wine shop and cheese shop right there in the village shops just south of John's Island. Just because we found out it's cousin of a childhood friend of young people that works for me that owns the shop.
Oh, I see.
When you mentioned about advertising with us and all,
So I told her, I was like, you guys, he's got Vero Beach magazine.
you wanna go hit them up, maybe? You think they want that?
Patty, come to that, April 9th,
Okay, April 9th.
like 6:30, or April 7th, I'm sorry, Thursday nights. And
Which time? What time?
6:30 at night.
1 minute.
So it's gonna be a small intimate gathering, we're not gonna have 20 people there, it's just gonna be, small intimate gathering, but we're getting.
You sit down. We have 1 minute and 10 seconds.
Thursday. Sorry, where is it?
MrJustThinking.com is spreading epiphanies. I have learned something is worth what someone is willing to pay for it. As a child, my father collected coins, and he showed me how a dime could actually be worth a quarter if someone's willing to pay that for it. So I see more today selling for
I don't know why he
$1,000,000
wants to do it so fast, too.
Yeah,
I know. And now he just stood right there.
and that what that person is to pay for.
I turned the lights out because the fluorescent is a bunch of crap. So basically, all we're doing is, I'm not even here. I just want you to, you can do this, you can do anything you want.
Okay, just fire away whatever you need.
Best part is Indian River Walking Clinic is moving to a brand new space twice the size, just a few doors
Hold on.
down from the present location. So if you need fast, friendly medical care, visit Indian River Walking Clinic, Miracle Mile Plaza. They'll make you feel better now.
On my stomach?
I was saying, is that me or you?
That's me, I can't even tell. That's good. Go on.
All right, I'm back in.
All right,
Hold on, my music.
Okay, we're good. Thank you.
Thanks, man.
All right, we are back on Retire for Real Radio. As always, this is David Brooks, your host. We hope you're having a great time. I'm also the president and CEO, so shameless little plug of Veris Wealth Management. If you'd like to check out our company, it's veriswealth.net. That's V as in Victor, ERUS wealth.net. I know it's a funny name, but it literally translates to genuine, true, proper, and right, because that's what we focus on, try to give our clients great, genuine advice to help them make good lifelong decisions. So we were talking today, we've been spending most of our time talking about how the analysis of choosing an investment takes place, whether you're using a professional or doing it yourself. So we talk about fundamental analysis and technical analysis. And so basically fundamental analysis tells us what we want to buy or what we want to sell for that matter. In other words, fundamental analysis can also tell us this is no longer fundamentally a sound investment. It doesn't make sense. The company's not making money. Where could this be true, right? Well, obviously companies come and go and they come in business. For instance, Montgomery Wards, right? They're not even in business anymore. Woolworths, these were phenomenal companies and fundamentally great investments in their heyday. But there's also got to be a time where you got to say, that's no longer someplace I want to invest. And keep this in mind. Think about this. Insurance companies, right? They've been a very large and profitable industry, especially auto insurance. However, just within the next 5 years, you're going to see people driving driverless cars on a regular basis. Innovation is coming. So if the computers are at the helm, theoretically, there'll be less auto accidents. What would that mean for auto insurers? It could mean that they almost go out of business or become obsolete because there'll be so much fewer accidents because you take out driver error, which right now distracted driving from texting, et cetera, is the #1 cause of accidents. So if we could eliminate that, what could that do to an auto insurance company? So fundamental analysis can tell us, hey, this industry might not be a good place to invest, period, or this particular company. And again, great point right there. It doesn't have to be just specific to a one company or one bond or one investment. It could be much broader. And fundamental analysis can be very broad on the general market. Is it a good time to invest or is it a bad time to invest? Technical analysis can tell us specifically, is it technically a good looking chart, or is the stock technically something we want to buy based on what we're reading from different metrics, whether this is moving averages, how much volume is going into the stock, is the stock acting or behaving like you'd like to see it. But you put these together and you can get pretty good metrics on how to make investment decisions. Now, what we do that we think is much more sophisticated and we think is different, and why we think you'll get better advice, is we do what's called tactical money management. Now, there's a big difference between what's called tactical money management and strategic money management. Strategic money management is where you sit down with an advisor or an investment company, and they may have performed some fundamental research from their analysts and picked a basket of mutual funds, stocks, bonds, whatever the investments that they chose for you, right? That they believe if they asset allocate amongst all these investments, they're good fundamental choices. And maybe they did some technical analysis, and we find most don't, but maybe they did. And so they say, this is what we think we should invest in. And strategically, they allocate that money, and then they never look at it again. This is what we always call set it and forget it, right? Not the strategy we want to follow, because we know the world changes each and every day. Terrorism attacks, the economy, numbers, political unrest, it doesn't matter. There's always going to be some form of issue coming from out of left field, so to speak. And if it's just a strategic allocation, they're going to tell you, you have to hang on for the long term. Just hang on to that. And I don't believe that that works for most people today. Why is that? Well, if you strategically allocated amongst these great investments that look on paper today to be phenomenal investments because of the fundamental research, what usually most of these investment advisors are doing, or the guy who's telling you what to invest in, is they're basing this off of past performance. And this is very, very important. Past performance, as they always would tell you, is no indicator of future results. Yet 99% of all investment advisors base their recommendations off just that past performance. What we want to do is have forward-looking due diligence. If an investment manager or a fund manager for a mutual fund or an ETF or something has got great performance, that's great. But what's the likelihood in the current market looking forward into the future, the next 3 months, 9 months, year, 3 years, et cetera, that he will be able to replicate the results that he got? That's what I care about, and that's what you should care about. And that is what we call tactical money management. Forward-looking due diligence will help us choose investments that are going to do well going forward, regardless of how they did last year. And my experience in this, I got to tell you, I didn't always do this. When I first got into the financial services industry in the late 90s, there was a mutual fund that came out that was focused on solely companies that were on the net, the internet. And this was still very, very new and fresh at the time. It had a 99% return the very first year that I put money in it. Incredible. But since then, it lost not only all that money back, it is still basically down over 90% 15 years later. I don't own this investment anymore, but this is to show you that past performance is irrelevant to the future. And if you don't have somebody who understands true tactical money management, and one of the things we call is trend aggregation, and we won't have time to get into today, this is so important because future-looking due diligence is what you care about. What's the likelihood that that investment can perform again in the future, and in the short run and in the long run? And tactical money management, instead of trying to be predictive and guess, well, we think that based on our fundamental analysis, this is where the market's going to go, or this is where this investment's going to go, we simply react in real time. In other words, there's no guessing with tactical wealth management. Tactical money management is simply reacting in real time to all these different data streams, technical and fundamental analysis, all rolled into one, and making decisions in real time. The big advantage here is that tactical money management will not always outperform strategic wealth management in the short run. In the long run, I believe it will. But what it can protect you from is a major drawdown. If you're in one of these buy and hold portfolios and your advisor is asleep at the wheel, or you've bought a basket of investments and you never look at it, and it gets cut by 30, 40, or 50%, and all we have to do is go back just 7 years ago to 2008. This happened to many people. They lost over half their retirement assets, half the wealth they've created, because the guy told them, well, fundamentally, we got to stick it out. You got to hang in there. Just investing is a long term. See, look, it came back. And here we are 6 years later. Sure, it came back. But if you lose 50% of the value of your portfolio, it's going to be, one, painful. You're emotionally may capitulate and sell out at the exact wrong time. And two, how much money do you have to make back to get back to even? If you lose 10% of your money, you only have to have basically an 11% gain to get even. If you lose 50% of the money, you have to have over 100% gain just to get back even. And you typically don't make 100% back in 1 year. Historically, it's going to take you 6 or 7 years. So can you afford to have that kind of drawdown? If you're at or near retirement, I say no. I say even if you're 30 or 40, you really can't afford to have that. So what tactical money management, if done properly, will help you avoid the major drawdowns. So I've learned over my career, whether someone is very aggressive or very conservative, 15% is almost that magical line in the sand. Not exactly for everybody. But if your account value draws down more than 15%, emotionally, you may not be able to handle what it's doing to you in your day-to-day life. It may help you make bad decisions in other areas of your life because emotionally, you're thinking about your money. So if you have a tactical wealth manager that will make sure you don't go down that far, if you have some sort of protection or mechanism, and you can still get the upside gains, but limit your downside, you're going to outperform and you're going to meet the outcomes that you desire. And that's what money management is really about, is helping people achieve the outcomes. Not necessarily about the performance of the day-to-day markets. What do you want to achieve? Does your advisor have a plan to help you achieve it? That's what you need to be focused on. And that's why we believe tactical wealth management is so much superior to the guys that are just going to do this plain old asset allocation and set it and forget it model. And if that's what you've got right now, it may be time for you to have a second opinion or to talk to somebody new. So if you would like to do that, you can give us a call. And we're not the answer for everyone. Let me first clear that up. Veris Wealth Management, and I also refer to other advisors. I'm not the perfect choice for everybody, but it will help you make the right choice and find somebody that's going to help you achieve your outcomes. So if you'd like to take advantage of our free 1-hour consult, you can send us an email at info, I-N-F-O, @retireforreal.com. That's retire, the number 4, real.com. Or you can call us at 772-237-3440. That's 772-237-3440. And we'll be happy to steer you in the right direction. Now, if you're out there looking for an advisor, right, and you are thinking maybe it's time to have a discussion or have a second opinion, I always joke about the 5 keys I want you to focus in on. So let's go over those real quick because we haven't talked about them this week yet. Never, ever, number 1, never, ever agree to do business with any financial advisor, insurance agent, banker, anybody in the financial services industry on the first visit or the first time you talk to these people, whether it's online, on the phone, face-to-face meeting. There's no reason to move forward in that first visit. It should be just like a get acquainted meeting. See if there's a fit. See if you guys mesh. Number 2, so important. How does that advisor or firm plan on being compensated for helping you achieve your goals? And this is very important. There are many different models that work, and it's okay, in all these different models, as long as it's transparent and you understand it. So there's commission-based guys. They sell products or services like annuities and other things, and they get paid from the product. You don't pay them a commission, but the product pays them a commission, right? And then there's straight commission brokerage. When I started the industry, if you wanted to buy a couple hundred shares of a stock, it cost you a couple $100 transaction fee. The advice was almost free, right? But you paid for the transaction. And that's a transaction-based relationship. Every time you make a transaction, your advisor or broker gets paid some kind of money. And then there's fee-based money management or fee-only money managers, which we believe is where you're probably going to be most comfortable. The reason being is the only way the advisor can grow his revenue is if he grows his accounts of his clients. So it kind of puts you on the same side of the table. Regardless, whatever the metric or how you choose to compensate your advisor, just make sure it's transparent and disclosed and you're comfortable with it. So very important. Number 3, this is the most important of the 5 keys. Is your advisor acting as a fiduciary for your money? If he cannot answer this question to you, look him right in the eye. Are you a fiduciary for me? And if the answer is no, that should be a deal breaker. There's what's called a suitability level of recommendations and one that's working as a fiduciary for you. Suitability is, well, I think it's suitable for Mr. and Mrs. Jones, but it doesn't necessarily hold the advisor accountable. When someone acts as a fiduciary legally, they are bound to a much higher standard and must help you do what's in your best interest, even if it's not in the firm or the advisor's best interest. Very, very important. Number 4, unfortunately, we've all heard of Bernie Madoff, right? Madoff made off with the cash because people wrote the check to Madoff's company. You should never let your advisor have the access to your cash, right? You shouldn't write a check to the firm. So don't write a check to, to Smith Stanley or whoever these other firms might be, right? Obviously, we changed the name on purpose there, but you should have a reputable third-party custodian hold your assets, and your advisor simply has a contract to invest those on your behalf and has the right to move the money around for you, but can't actually access your capital. So there's third-party custodians such as Charles Schwab, Fidelity, TD Ameritrade. These are all large, well-known institutions, and you should have 24/7 access to see your funds anytime you want. So that's number 4. Never give custody of your assets to the advisor. And number 5, make sure you have a risk tolerance form taken out, an investment policy statement that will guide the relationship. So if there's any areas you're uncomfortable with, this is where you will disclose that, and the advisor would know you're not comfortable investing in that area. And if you want a financial plan, this should also be included in that, where they'll give you a written financial plan if that's something you want to have done. These are important metrics. So hopefully you'll keep these 5 tidbits in mind when you go to interview any advisor. So again, if you want a second opinion, if you'd like to have one of our advisors sit down with you, whether it's on the phone, over the internet, technology is great today, or face-to-face, you can call us at 772-237-3440. That's 772-237-3440. You're listening to David Brooks of Ferris Wealth, and this is Retire for Real Radio. We'll be right back after these short messages.
Gotta do you again. I had it on ISO 80, which means doing great in direct sunlight. Yeah, all he has to do for the lighting, he's talking about putting curtains up.
Yeah, that's what I mean. You got this.
Yeah, but you can still see you. That's okay. But the idea is all he has to do is get a spot and just shine it on the ceiling. That's how, if I take my flash,
ambient light behind, yeah.
right,
Yeah.
and that would, like right here, and that would just somewhere.
Yeah, you could just put a little track lighting and just turn them up,
Yeah, yeah. I had it on ISO 80, which looks like 80 film speed.
Yeah.
Which is not good, and I can shoot with 1600 on this new sensor. Yeah, on the chair's fine. Yeah, we like that. Woo-hoo. Oh, dude, GQ, baby. Okay, hold on. Let me readjust here.
Skin cancer
Here we go.
can often go undetected until it's too late. What you can't see can hurt you. Florida sun, our biggest asset, can often damage your skin.
I think that's it.
When you're
Drop something in there, right? You find something that's good.
Here.
And Dr. Simi Thuresha.
You gotta Photoshop that gut out, man.
What can we do? Yeah,
I'm sure that's good enough for now.
No. All I have to do is crop up. I have to do that for red all the time. Guys, the guy loves food so much. Like even that song he played this morning, "The Lamb of God."
Yeah.
What's the key word?
Lamb with mint sauce.
Braise it like a Dijon, demi-glaze.
Yeah. That's funny.
Yeah. That's when you hear Dave Walsh always laughing at him. He says, "You should have been a chef."
Yeah.
Anyway. Thanks, buddy. I'll put the light back on.
All right.
And sugar-free desserts. Just Desserts, VeroBeach.com.
masterful presentations of both flavor and form. A complete dining experience to meet all your expectations. The Tides Restaurant, 3103 Cardinal Drive, Myrtle Beach.
All right, we are back in the home stretch here on Retire for Real Radio. We hope you're enjoying your day and hoping you're finding the information informative. So we, just before break, talked about if you are in need of a second opinion, or maybe you're looking to interview a financial advisor for the first time, or you just want to know, is what we have right now okay? We offered up our 5 keys on how to hire a financial advisor. Never ever agree to do business on the first visit. Understand the compensation model. Only work with people that are fiduciaries. Never let the advisor take custody of your assets, and get a risk policy statement in writing so that you have some parameters and limitations on where you're not comfortable or you are comfortable investing. Very, very important. We've also been talking, we spent a lot of time today on the analysis that some of these investment houses do, or even DIY investors, do-it-yourselfers, on what they do when they're trying to pick an investment. So we talked about what the difference between fundamental analysis and technical analysis is. Fundamental analysis, in essence, basically tells people what it's okay to buy or what to sell. And technical analysis tells you when to buy or when to possibly sell. So that's how those two work together. And then we also talked about the difference of understanding what true tactical investment management is versus the strategic guys that will just do this analysis and then set it and forget it and never look back. In other words, they only do the analysis to buy your investments. They never do any analysis of when to sell them or tactically make shifts instead of just rebalancing on a particular date. That one I've never understood. Well, we're going to rebalance your portfolio every year. Well, if April 3rd is the day you're going to rebalance, is that a good thing or a bad thing? Well, what if you rebalanced April 5th? It could have had a huge difference on the portfolio. So being tactical, we're able to make better decisions on how to allocate money amongst better strategies versus allocations of assets. This is important stuff. And if you'd like to get some more in-depth information, you're welcome to call us at 772-237-3440. So that's a lot of information we covered today, and I know I try to slow down on the radio. Those of you who know me in person or have met me know I can talk 150 miles an hour, and so I do my best on the radio to try and keep it slow so that it comes across where you can understand what we're saying. But if I get to that point where you're like, wait, what did he just say? Just send me an email and we'll break it down for you at info@retireforreal.com. That's retire4real.com. So we're only got a few minutes left in this week's show. So what I want to talk about is some of that analysis that's going on. So the market here as of late has had a bit of an up and down kind of a swing. And so the market's corrected and went down over 10%, rallied back up, and then did it again, right? And so we did it last August. We had a good correction. Markets rallied back up after going down in August and September of last year, rallied back up, and then right at the end of the year, starting this new year, the market sold off pretty violently, one of the worst starts ever to the markets in the history. And then as of recently here, we're coming up close to Easter here now, so Easter's this weekend. The markets have rallied in the last 5 weeks about 12% off the bottom. Yet here we are going into Easter weekend, and the markets are still negative for the year. And so this can be very frustrating for clients. They see this huge rally, or they'll see it on the news, and then they find out that they haven't made any money yet this year. Well, the markets haven't gone anywhere. But things you need to understand is the technical analysis will show you that it's funny how the market rallied up and got right to its trend line and turned away. And we can't explain this on the radio, but this is why someone who's a good tactical money manager who's looking at all these different metrics can help you make better decisions in the long run. One of the areas you need to be concerned of, though, is earnings and top line growth of the S&P 500. So all the companies out there have reduced their earnings estimates by about 9% for this year. That's a pretty big reduction. And what does that foretell? Does that mean that there's a recession coming? Well, the numbers don't point to that just yet, but certainly it's a possibility, and you have to be very cognizant of that. But what I really get nervous about is when the revenue, the top line numbers of these companies gets cut. So their earnings cut is one thing. And the last few years, companies have been very pragmatic and due diligent in increasing productivity to the highest levels we've ever seen in our lives. In other words, companies are more productive now, getting more done with less resources than ever before. And that's been a good thing. However, we may have run our course on how much we can increase productivity in the short run. We're always going to have innovation and increase productivity in companies. But now what we need is for these companies to continue, if the market is to keep going forward, they have to continue to grow sales and top line revenue at companies. Well, coming into this year, from most of the Wall Street analysts, the estimate was that top line revenue was going to grow at a little over 4%, almost 4.5% for 2016 over 2015. So not bad growth, right? If our economy was growing at 4.5%, we'd all be pretty happy, to be honest with you. Well, now after going through almost the first quarter here of first quarter earnings reports that came in, and the companies are all knocking down their estimates on revenue growth based on metrics that they see. The estimate now is just 2% for 2016. So what does that mean? They've cut the revenue forecast, the growth forecast in half. Could that be a negative for the positions or the equities and the values of these companies? Well, certainly. However, here's the key element. It doesn't matter. We're not trying to predict that, right? If you have a true wealth management system and money managers in place that are tactical and are going to react in real time, you're going to be better off over the long haul. Because if those earnings get cut even more and it goes negative, then that would be a precursor saying, hey, a recession may be coming. And there's certain sectors that are already in recession. That's reality. Our manufacturing sector, energy sector have been in recession for the last year. But that doesn't mean the whole economy has been drawn down. However, it could slowly go down. Unfortunately, we've had recent terrorist acts. There's all kinds of things that could come out of the woodwork and put a little spook into the markets. If you have a money management system in place that can react in real time, you're going to be better off in the long haul, because you're not going to have to experience, hopefully you will not have to experience a 40 or 50% drawdown in your assets. And unfortunately, this happened to a lot of clients that are just now getting to retirement, not once, but twice in the last 15 years. When the dot-com bubble came undone and the 9/11 happened, the huge terrorist attacks happened, the markets did not react well. So it took 3 years in negative returns in the early 2000s before the markets got their footing again. If you retired at that time, how would that have affected you if you just had a buy and hold strategy? And then the markets did great, brilliant for about 4 or 5 years, rolled right up there. And then we had the financial and housing crisis come undone. And 2008 was one of the worst recessions we've ever seen. However, it's not the worst we've seen. And media sometimes plays that up. But I'm going to tell you, if you were around, I was a kid in the 70s, that was actually a much worse recession to the everyday American. But we'll tackle that topic on another show. However, if your account just got it back to even or just made your money back in 2007, and then you got drawn down by another 40 or 50%, mentally, a lot of people just gave up, pulled their money out of the investments they had and didn't get the returns. The markets have gone up 200% since then. And a lot of people didn't get to participate in that because emotion, it's a very real thing. So you need to understand, you need to have a tactical wealth manager helping you achieve your goals. We are unfortunately out of time this week here on Retire for Real Radio. If you would like to sit down and find out if tactical wealth management is right for you or how to hire an advisor, you can do so by calling us at 772-237-3440. That's 772-237-3440. As always, I am your host, David Brooks, President and CEO of Veris Wealth Management. Check us out at veriswealth.net. And until next week on Retire for Real Radio, please have a wonderful and prosperous week. Happy Easter out there, everybody, and we'll see you next time.
I want some money for nothing and then chicks for free.
Well, that ain't working. That ain't working. Nothing in your chicks.
video of nothingness. Maybe I'll go in there and like moon them. Stop the broadcast.